the benefits of real estate for tax. One of the issues I had last year was I'm coming up on the end of the year and I have a significant tax liability. When the tax liability became big enough, it became real to think, shit, I should probably clear my schedule and focus on how to fix this problem. And so then I got into learning about all these different vehicles, right? Insurance vehicles. But one of them is real estate. How did that play into your world, and what do you do with it now? How do you pay less taxes?
Today, bonus depreciations, I think, are the one of the best vehicles. I mean, basically, I look at how much net profit am I going to make in my business, and then let's say you buy a $5 million commercial piece of real estate. You'll generally get about $1.5 to $2 million in depreciation. It's just about 30 to 40%. That's usually how it turns out to be. So if I know I'm going to make $1 million of net profit this year, that means I know I need to buy about $2 to $3 million worth of commercial real estate so I can get a bonus depreciation to offset my gain. So each year I kind of know how's the business slate projected to do. I need to be acquiring real estate that's projected to write all that money off. So I strategically plan real estate acquisition in relation to net profit projections to make sure I don't pay tax. This particular strategy requires a real estate professional designation. So you got to do a fair amount of real estate investment and or have a spouse that could be licensed as a realtor, which often is how that's done. And then her designation, which would be valid and not gray, would qualify. That's a simple one today. I will say that that will change. They're already trying to rule that out. Maybe someone comes and changes that. There seems to be a huge emphasis on green technology. So maybe in the future, it's like if you build a solar farm, you get 30% tax write-offs or whatever. It's not really that difficult. The government's so slow to change the tax law that by the time they change it, There's another thing. Read the rules and figure out what the new game is.
The idea is you buy this, $4 million piece of real estate, and the idea of a cost segregation is to get the bonus depreciation is that you can segregate the cost of the things in the building for the things that are going to depreciate faster than others. And the idea of this really is that, for example, plumbing, electrical, flooring, or whatever, lighting is going to have to be replaced faster than the sticks, right? Or the concrete of the building itself. As a result, instead of depreciating the whole building over 27 years, you can depreciate those things over 5 years, but you can take the bonus depreciation on the first year. So of this $4 million property, 30% of it can be depreciated in 5 to 7 years, and you can take the entire write-off on the first year, right? But you have to do a cost segregation study to analyze what can be depreciated faster and what qualifies for this bonus depreciation. It's also worth noting that if you sell the building, when you sell the building, that all unwinds, and you have to then pay back that bonus depreciation that you accelerated. So if you want to go down this path, you have to know that the only way that money becomes sort of free and totally gone is if you hold the building for the duration. Or if you want to sell it later, you just have to know that you have to deal with that tax ramification at that point.
Or 1031. That's why I think you just keep acquiring in bonus depreciation, acquire bonus depreciation, and just hold.